Hello folks, I hope you're all doing very well as we lead up to Christmas and another festive season. Along with our market update for September, I'm now going to be giving a quick video market snapshot of what's been moving markets each quarter. So we've just gone through the September quarter and September will be known as an above average quarter in terms of market performance and returns. Your superannuation balances should be looking pretty healthy, and it's always lovely to see some good positive quarters coming through, even though there's been a huge amount of geopolitical events and uncertainties globally. This does hide, to a degree, some intra-quarter volatility, and quite substantial volatility. In fact, in late July, we had what was known as the Japanese carry trade unwind. Just in a nutshell, a lot of hedge funds globally and big institutions globally participated in what's called this yen carry trade, where they'd borrow money, borrow yen very cheaply with very low Japanese interest rate settings, and they'd find higher yielding assets to invest in globally or in Japan, etc. What boosted profits over the last few years in this trade was the fact that the yen has continued to depreciate in value over time. Now, a combination of factors hit this particular trade, though, late in the later stages of July. One of them being some softer employment numbers out of the US. Now, the US then recalibrated their monetary policy settings. We've seen a 0.5% decline in their cash rate, and that sort of coincided at the same time with the governor of the Japanese central bank indicated that they might put in some measures to increase Japanese interest rates. So that sort of reversed the decline in the yen, and it's just set in motion a chain reaction where a lot of the participants in this carry trade had to quickly sell and unwind their positions to raise capital very quickly to repay their yen denominated debt in a very rapid and timely fashion. That saw quite substantial declines in the Japanese share market, the United States, their tech sector in particular. We saw declines here in Australia as well. What was very interesting and really positive, though, defensive assets in portfolios like bonds that appreciate in value with declining short, medium and longer term interest rates. They actually insulated and provided fantastic diversification benefits, which was really great to see during that episode. Now, on top of that, it always pays not to sort of have any knee-jerk reaction, especially for events like that. Markets stabilised, they've sort of started picking up again into August and then in September. And then in the later stages of September, there was a big bazooka of a stimulus announced through Beijing to try to pump prime the Chinese economy that's been suffering under this sort of oversupplied property market over there. So that they've looked at measures to decrease interest rates, decrease bank reserve requirements, directly stimulate the share market in China to try to sort of pick up this wealth effect over there and try to make their consumers a bit more confident to spend some money, etc., and get a little bit of activity going. So we don't know where all that will pan out. It certainly stimulated the Chinese share market, and it also led to a rotation out of Australian banks and into miners again. Now, I'm not sure if this stimulus will have the same impact on Australian miners as what it did back in the early or mid-2000s, etc., where there's huge infrastructure stimulus in China and whatnot, but only time will tell. So anyway, that's the September quarter in a nutshell. Please have a read through the market update report for more detail. And as always, myself, Jenny, Amir, and the team at Peak Partnership Wealth Design Solutions are always here to answer any questions or field any concerns that you may have. all the best with the festive season on the horizon. Thank you.